Welcome to Breaking News to Trading Moves. Today we're looking at gold. Prices have been hitting fresh records, spot prices actually pushing past $4,000 an ounce.
Yeah, quite a move.
And it seems like it's being driven by, well, two main things. People looking for safe havens, with market uncertainty, and also growing bets that the Fed might start cutting rates soon.
Absolutely. And what this record price does, it creates this immediate uh, friction in the market. You get a very clear split.
A split? How so?
Well, you've got companies that are direct beneficiaries, seeing their margins potentially stand quite a bit.
Yeah.
And then you have others suddenly facing pretty intense pressure on their input costs.
Okay.
So our task today is really to walk you through that dynamic. Look at the winning side, the losing side, and name some of the specific companies involved in this whole picture.
Right. Let's start with that core conflict then, because, intuitively you might think record gold prices. Well, that's good for everyone involved with gold, right?
You'd think so, wouldn't you?
Yeah. But some analysis, Reuters, for example, specifically mentions margin pressure for luxury jewelers. They used LVMH, who owns Tiffany, as sort of a global example for what might happen with U.S. retailers. So why is it so different for a jeweler compared to, say, a gold miner?
It really comes down to speed and leverage. It's about where they sit in the value chain.
Okay.
So historically, if you look at miners or royalty and streaming companies, they tend to offer what we call leveraged upside when bullion prices spike like this.
Leveraged upside.
Yeah. But for jewelers, retailers with that fine jewelry exposure, it's kind of the opposite. Gold is their raw material, their inventory.
Ah, right.
So if they bought gold maybe 3 months ago when it was, let's say, $3,500 an ounce,
Yeah.
but now they have to price their finished pieces based on replacing that gold at $4,000, well, you see the problem.
Their costs just jumped.
Exactly. There's immediate growth margin compression,
Oh.
unless they can react super quickly and raise their retail prices. And that comes with its own risks.
And it looks like the market's already reacting to this. We're seeing reports that funds have been moving into gold miners, probably anticipating that these higher prices might stick around for a bit.
That makes sense, following the potential profit.
So let's dive into those clear beneficiaries first, the gold miners. They're benefiting from, well, obviously selling their gold at higher prices, but also from something called operating leverage. Let's start with a big one, Newmont. That's ticker NEM. They actually beat earnings expectations recently, and a lot of that was attributed to the higher bullion prices. They're really seen as the strongest large-scale pure play gold producer listed in the U.S.
Right. NEM is definitely key. And another one often mentioned alongside them is Barrick, ticker GOLD.
Derek, okay.
Both are large liquid producers, and they have what the market often refers to as torque when it comes to gold price moves.
Okay, wait, torque. That sounds like physics or engineering. For listeners maybe not steeped in mining jargon, what does that actually mean for their profit and loss statement when gold jumps 5% quickly?
Yeah, it's a good question. Think about how a mine operates. They have enormous fixed costs.
Right, the digging, the machinery.
Exactly.
Yeah.
The huge processing mills, the specialized workforce, the infrastructure, all that stuff costs roughly the same whether gold is selling for $3,000 an ounce or $4,000 an ounce.
Okay, the costs are locked in, more or less.
Pretty much. So once they've mined enough gold to cover those massive fixed costs,
Yeah.
every extra dollar they get from a higher gold price, well, it flows almost directly to their bottom line. Profit.
Ah, I see. So the profit grows much faster than the revenue increase itself.
That's it, exactly. That rapid acceleration of profit relative to revenue, that's the torque they get. And it's powerful because it lets them improve their margins quickly, maybe pay down debt, strengthen their balance sheets.
Got it. So that's the winner category that involves, digging stuff out of the ground, high capital spending, high fixed costs. What if you want exposure to gold prices, but maybe without taking on all that operational risk?
Good point. That brings us neatly to the second group of winners, the royalty and streaming companies.
Right. These are often described as having inherently high margins.
They do. Companies like, say, Wheaton Precious Metals, ticker WPM, and Royal Gold, ticker RGLD, their business model is different.
How so?
Well, they typically provided capital up front to the miners, maybe years ago, to help fund the mine's development.
Okay, like an early investor.
Sort of. But in exchange, they didn't get equity in the mining company itself. Instead, they secured a contract. This contract might give them the right to buy a certain percentage of the future gold produced at a fixed, very low price. Or sometimes they just get a percentage of the revenue from the sales, which is the royalty model.
So wait, They paid their cost for the gold years ago when they gave the miner the funding.
Essentially, yes. Their major capital outlay is in the past. So now, under their contract, they might be acquiring gold for, let's pick a number, say $500 an ounce.
And the market price is now $4,000.
Precisely. Look at that spread. It's almost pure profit margin for them on that metal. And the beauty of their model is they have very limited exposure to the things that often plague miners. Unexpected cost overruns on building things, labor strikes, mines having technical problems.
They avoid all that operational headache.
Largely, yes. So when gold spikes like this, they capture almost all of that upside with much less operating risk. It's structured to maximize the benefit from price increases.
Okay, that makes a lot of sense. Miners and royalty streamers. Before we get to the companies feeling the pinch, is there another winner category?
There is, actually. It's maybe less obvious. Pawn and resale operations.
Pawn shops.
Yeah. The analysis points to companies like First Cash, ticker FCFS, and Easy Core OP, ticker EZPW.
Huh. Why do they benefit so quickly when gold runs up like this? It seems less direct than selling mined gold.
It's tied to the volatility and the value of the metal itself. Two things happen almost immediately for them when gold spikes.
Okay.
First, think about what people pawn. Often it's jewelry. Gold jewelry. So when the price of gold goes up, the value of that collateral they hold against their loans instantly increases.
Right, so the loans they've made are suddenly better secured, less risk.
Exactly. It improves the quality of their loan book.
Right.
But the second thing is perhaps even more powerful for their short-term revenue. It's about the melt economics.
Melt economics? What's that?
Well, inevitably, some pawn items aren't reclaimed by the borrowers. The pawn shop takes ownership. A lot of this is gold jewelry.
Okay.
They can then liquidate this unclaimed inventory, often by melting it down and selling it as scrap gold based on its weight and purity.
Ah, I see.
So when the price of bullion jumps dramatically like it has, the value they get for that scrap gold goes up instantly. They can sell it into market at the new, higher price.
That's a quick cash injection for them.
A very fast, high-margin revenue stream, yes. It improves how quickly they can turn over that part of their inventory and realize the cash value. It's a direct benefit from the price surge.
Okay, fascinating. So miners, royalty streamers, and pawn resale operations on the winning side. Now, let's cross over to the other side of this. The losers, the ones grappling with that input cost squeeze.
Right. This is where the picture gets tougher.
Let's start with U.S. jewelers. They seem to be caught in a difficult spot. Immediate cost pressure from gold, but if they hike prices too much or too fast, they risk scaring off customers, right? Volume risk.
That's the core problem, the volume risk. Think about companies like Signet Jewelers, ticker SIG, or Movado, ticker MOV. They depend on a steady flow of customers making purchases, especially for bigger ticket items like, engagement rings or luxury watches, where gold is a key component.
Makes sense.
Gold is a fundamental input cost for them. If they have to raise their retail prices significantly to protect their profit margins because gold just shot up, well, they risk deterring buyers, particularly for discretionary purchases.
So even if they maintain their margin percentage on each item sold, they might sell fewer items overall.
Exactly. Lower total sales volume means lower overall profit dollars, even if the margin per piece looks okay on paper. It's a really painful trade-off they have to navigate between price and volume.
Okay, jewelers are feeling it directly. What about department stores? The ones that have, fine jewelry counters. We're thinking Macy's, ticker M, and Nordstrom, ticker JWN.
They're also mentioned as facing pressure.
But I have to ask here. Macy's and Nordstrom, they're huge retailers selling everything from clothes to housewares. Is their fine jewelry section, gold necklaces, bracelets, really a big enough part of their overall business to land them on a loser list because of gold prices? It feels like it might be a small fraction of their total sales.
That's a really fair question.
Yeah.
And you're right, it's unlikely to drastically change their total company revenue overnight.
Yeah.
The issue isn't so much about the top-line sales number, but more about the margin drag that comes from their category mix.
Margin drag. Explain that a bit more.
Okay, so fine jewelry, compared to, say, apparel or cosmetics, typically has a higher cost of goods sold already. Gold is expensive. When the input cost of that gold shoots up suddenly,
Like it has now.
and maybe the department store is slow to adjust its retail prices, or perhaps they even have to run markdowns to clear out older inventory that was bought based on the previous lower gold price.
Okay.
The negative impact on their gross margin dollars from that specific section, the jewelry counter, can be disproportionately large. It might not sink the whole ship, but it acts as a weight pulling down the overall margin performance for the entire store or company. So even if it's a smaller slice of the business, its poor performance on margin can be noticeable.
Got it. So it's about the profitability mix, not just total sales.
Okay.
Okay. That leaves one more category on the potential losing side: luxury marketplaces.
Right. Companies like The RealReal, ticker REAL, and Farfetch, ticker FTCH.
Now, for these guys, especially maybe Farfetch, a lot of their inventory isn't stuff they own directly, right? It comes from consignors, people selling their used luxury goods through the platform. How does a sudden spike in gold bullion affect their business model?
Yeah, their exposure comes through a different mechanism. It hits their core revenue stream, which is the take rate.
The take rate, their commission, basically.
Exactly. They act as the middleman. They connect someone selling a, say, used gold bracelet with someone wanting to buy it, and they take a percentage fee from that final transaction price. That's their take rate.
Okay, so how does volatile gold mess with that?
Well, think about the pricing. When gold bullion jumps from $3,500 to $4,000 really quickly, the seller of that used gold bracelet now expects a higher price because the underlying gold value went up.
Makes sense.
But the buyer in the secondary market might take some time to adjust to that new higher price level. There's a lag. So that gap between what the seller wants based on the new gold price and what the buyer is currently willing to pay, it tightens. The buy-sell spread compresses.
So there's less room for the marketplace's commission in the middle.
Precisely. Until those resale prices in the secondary market fully catch up and reset higher to reflect the $4,000 gold, the marketplace is squeezed. They either have to accept a lower commission percentage, which is a direct hit to their take rate and thus their revenue, or they risk the transaction not happening at all because the seller won't accept what they see as too low a price relative to the new gold value.
So it stalls business or cuts their share. A tough spot either way.
Yeah, rapid volatility makes pricing difficult in those secondary markets.
Okay, so pulling this all together, this analysis seems to highlight a couple of core ways you might think about trading this dynamic. First, there's sort of a momentum approach, focusing on going long, the beneficiaries, the miners and streamers we talked about, so maybe a basket including NEM, GOLD, WPM, RGLD. This strategy kind of relies on gold staying strong, maybe above $4,000, and also on that market expectation of eventual rate cuts remaining in place.
That's one way to look at it, focusing purely on the upside potential.
And the second potential approach mentioned is more of a relative value or paired trade, essentially betting on this divergence between winners and losers continuing.
How would that work?
It would involve being long the miners, like NEM or GOLD, while simultaneously being short the jewelers, maybe SIG, who are facing the cost pressure. Again, the idea works best if gold stays elevated.
So playing the spread between the two groups.
Exactly. Betting that the miners will outperform the jewelers as long as these conditions hold.
Interesting. So as people listening think about this, what should they be watching for next? What are the key things to monitor?
Well, looking ahead, you really want to keep a close eye on the upcoming earnings reports and, crucially, the guidance from luxury goods companies and retailers.
What specifically in the guidance?
You're looking for clues about their pricing power. How quickly have they actually been able to raise retail prices to offset this gold spike? Are they talking about it? And just as important, are they seeing any changes in consumer behavior?
Like customers balking at the higher prices.
Yeah, or shifting their spending. Are people maybe buying less gold jewelry and perhaps shifting to other luxury categories because the ticket price for gold items has jumped so much? Any commentary on that kind of category mix shift will be really telling about how sustainable the situation is for the retailers versus the miners. That's probably the key data point to watch for going forward.
Makes sense. Real-world impact on sales and pricing strategies.
Precisely. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.